Hello, everyone. Good afternoon. This is our, usual bi-weekly session with Jay Pelosky. We have lots to talk about, and of course, we feel much better than we did, in the last one. So it's been quite a good, days, last week, and for those of you who are old enough to remember the Simon and Garfunkel song. Jay decided to name, this week's report, after a famous song, "Bridge Over Troubled Waters," and let me hand over to him, and we call this one, the bridge, the earnings bridge over, troubled waters or troubled markets. So thanks again, Jay, and again, thanks for joining us and in the middle of your well-deserved vacations.
Yes, only for you, Roberto, and the good folks at Home Research and the audience here for our live sessions. I mean, they're so much fun that I couldn't say no. Even though, yes, I am up in upstate New York, near the Catskills Mountains, so it's nice and cool, and there are trees and everything in the background, and so I'm really enjoying it because last week, while it was great for the markets, was really brutally hot in New York City. And so, yeah, I thought that the Bridge Over Troubled Waters song kind of made sense here, particularly when you think about earnings as being that bridge over the troubled waters. And we'll get to that in a little bit. But I thought last week was really important for a number of reasons that I'd like to lay out here at the top. First was the fact that we had 3 days in a row of a green screen for the S&P, first time since May, so several months. That's a very long period to go without stringing together a couple of up days. And with today's kick save into the close, it's been green 4 out of 5 days. So I think that's first something to acknowledge. And it made me think last week when I was getting ready to write the musings about whether or not maybe crypto's collapse was the last shoe to drop, right? Because it was the big fad. It was the most egregious fad of the COVID period. And when Terra broke and Luna collapsed and Celsius collapsed and 3AC collapsed, maybe that's the signal that the last shoe has dropped and the biggest fad of the last cycle has now been, kind of done and dusted. And at the same time, we've seen ARK and Apple and Netflix and Tesla, all the important names of the innovation space, of the big cap space, start to do better. And ARK in particular has done much, much better. Tesla last week reported beat earnings by 25%, a very good result. And this week, of course, we have the bulk of the big cap techs reporting. But, there was a better tone last week. And I think that the crypto bottom, the ARK innovation, big caps tech stocks doing much better. But I think the really important one was the B of A fund manager survey report, which you and I know it's pretty well known in the industry. It's well respected because they do have a very large group of fund managers who do take their survey regularly. So it's a consistent read. And what was so telling about last week's issue was titled, by the way, "The Full Capitulation." So really suggesting in an array of charts and tables that sentiment has really never been worse. And growth expectations and profit expectations, they pointed out, were at all-time lows. Cash levels at the highest since 9/11. Risk exposure lower than at the lows of the Lehman Brothers collapse and the great financial crisis of 2008. And that to me is just a very, very telling sign because, I was involved in the markets back then. You were involved in the markets back then. And we are nothing like, today is nothing like 2008.
Yeah.
In 2008, the entire U.S. financial system was days away from implosion. The entire U.S. financial system, days away from implosion. Today, we just had the banks report across, on average, a 12% return on equity, making billions of dollars a quarter, the best loan growth in a decade. Finally, with rates backing up, they have a rising net interest margin, trading at 1x book. And our good friend and I know a good contributor to Ohm Research, Barry Knapp at Ironsides Macro, pointed out that a 12% ROE typically translates into a 1.6 times multiple on book. And today, the banks, because of such negative sentiment, are trading at 1x book.
Yeah.
So, to me, that fund manager survey really struck a chord and suggested to me that people were just way too bearish. And that's the type of thing that tends to make a bottom. We wrote about it a few weeks ago. We titled the piece, "The news doesn't have to get better, just less bad." And this is an example of that. When you think that the world is going to be worse than 2008, it doesn't take much for the news to get to be better than that, right?
Absolutely, yeah. No, it's a great point. I mean, and you mentioned that quite a few times, and I agree. We had the big banks report, and what they show is nothing, compared to what we saw when we lived through in 2008. Even if one wants to assume that the economy is going to be worse, I don't know, in 6 months' time, or there'll be a recession, whatever. I mean, it's nothing even close. So I guess.
The system, and again, you were a bank analyst. Goldman and Morgan, they were leveraged 40 times going into 2008-9, right? The leverage ratios were just insane. Today, they have a fraction of that leverage. So it's it's a sign of a market that has gotten too bearish, too over its skis in terms of negativity. So when the news is a little bit better, then you go ahead and you get some upside reversal like we've had in the last week or so, which is, as we say, is very welcome. But then, to your last comment there, the bears who are still out there in force, they're growling, saying, "Oh, it's only a matter of time before we have a recession, and then earnings are going to come down, and then that's going to be the next leg down for the stock market." And I think that's where we continue to be, the back and forth between the optimists and the bearish folks. And the bears right now are saying, "Well, just wait, it's going to come," as opposed to saying, "Well, we're already all bared up and we've got nowhere to go."
Yeah, no, exactly. And another point that you make, and I want to ask you, is about consumers and companies. Their balance sheets look quite strong, right? I mean, they it doesn't seem like we'll be close to what we had these days, and there'll be a balance sheet recession, right?
Again, yeah, spot on. I mean, households are record low unemployment, so people are working. Household savings off the chart as a result of COVID. Debt service as a percentage of disposable income towards the bottom of the historic range of the last 30 or 40 years, because that income is up so high and because rates have been so low. And yes, rates have come up a little bit, but it's still the bulk of the debt that's currently in hand is at much lower rates. So the debt servicing is nothing like what it was in 08. And on the corporate side, corporates have billions, if not trillions of dollars collectively, obviously, in the aggregate on their balance sheets. And the thing that I like to look at is the insider buy and sell ratio. And that tends to be a really pretty good, accurate indicator of what companies are feeling, as opposed to, CEO surveys where they're all super worried about the future. Insider buy-sell ratio is at one of the highest levels it's been at in years, suggesting that stocks are going to be fine, earnings are going to be fine. So I just, as we've talked about at TPW Advisory, we've been a proponent of the middle way between ever higher inflation and gaping recession. We think there's a middle path that the economies can go through as inflation rolls over, as growth slows, but does not collapse into a deep recession, maybe. And we might find as early as this week with the first read on Q2 for the U.S., we may see a reading that suggests the U.S. had negative growth for 2 quarters in a row. And people will be talking about recession, recession, recession. But really what counts for stocks are earnings. And earnings last week anyway, remember 2 weeks ago, our title was Title Fight. And we posited that it was a fight between the inflation champ and the earnings challenger. And last week, the earnings challenger won because the first blush earnings reports were pretty good. And the market obviously took them favorably. So recession, maybe a mild recession, still not a fan of the argument of a deep recession for the things we just talked about. Same holds true in Europe. And the end result is the earnings, not the GDP. If you look at stocks versus GDP, there's a very weak fit. If you look at stocks versus earnings, stock, price, stock performance versus earnings, there's a very good fit. So we're focused on earnings here at TPW.
Fantastic. And the other point that I wanted to talk about it later on when you said that what drives markets is not real GDP but earnings. And there's a point that you make in the musings, and also referring to something that Barry Knapp said, and also a couple of other people, is about nominal GDP. Sales, profits, they're all based on nominal GDP. And I want to elaborate a little bit on this. But from our side, of course, we in Brazil we have the benefit of living decades through high inflation environments. And in the U.S., of course, we did not have these problems. When you have decade after decade, like for 40 years, inflation at only 2%, people would always assume that whenever there is a recession, there'll be a hit, to a significant hit to profits. But when people are pricing such a negative scenario, they forget that we are still seeing a high nominal GDP environment, maybe close to 10%, and that's kind of an introduction I wanted to make. But if you can elaborate a bit on that, yeah.
Yeah, no, I think that's a key point, and we've been talking about it again for some time, arguing that investors do not understand the difference in the environment which we're in today, post-COVID, versus what we were in pre-COVID, right? And let's go back as a quick review. From 2015 to 2019, U.S. real GDP averaged 2.3%. Nominal GDP, which is the real GDP plus inflation, averaged less than 4%. Okay. So today, we are in an environment where nominal GDP is growing somewhere between 7 and 10%. In Q1, it was 10% nominal growth. Now, the bulk of that obviously was inflation. But as you just pointed out, earnings and sales are priced in nominal dollars. And I think it's not so much the sell side, the analyst side, because analysts have been very sticky with their earnings outlook, right? And even LPL, when they put out their first blush earnings report for last week, they noted that the bulk of earnings for 2022 as a whole have not changed in the first week. So there were 80, maybe 90 companies who reported last week, 72% beat ratio. So 72% of those companies beat earnings estimates. And importantly, even for the ones that didn't beat, the outlook for the full year is still relatively unchanged. And so the way we look at it, the earnings outlook is roughly 4% year over year in Q2. Okay. And if we're growing nominal GDP in the United States at 8%, then 4% nominal earnings growth is not that high a bar. And therefore, we went into this earnings period feeling pretty confident that companies would do fine and feeling that that would be a support for equities. And that's why we didn't, pull the ripcord a couple of weeks ago and get out and get into cash, because we felt strongly that this earnings environment was going to be supportive. And so I think that's where we're at. I think the sell side understands a little bit better than the buy side the importance of pricing nominal GDP and nominal sales and nominal earnings. But the buy side is, I think, by the end of this year is going to have a much better understanding of it. But the people who simply looked at the GDP and the weak GDP in Q1 and whether it's positive or negative, weak GDP in Q2, they're missing the fact that sales are growing at close to double-digit rates in the United States for the S&P 500, double-digit sales growth. And companies are having the ability to pass on price, input price hikes. They can pass it on to their client base for the first time, as you pointed out, in well over a decade. The whole post-09 period from 2009 to 2019 was a low growth, low inflation, low nominal growth environment. Companies had very little pricing power. Today, we're in a high nominal growth environment where companies do have some pricing power, and therefore earnings are, to some people, going to be surprisingly good, and that's going to be an example of the news being less bad. And therefore people saying, wow, I thought earnings were going to, one of my fundamental cases as a bear was that earnings are going to come down, and earnings are not coming down. So I have to be, I have to start being open-minded. Maybe I should put some cash to work. And those are the types of things that help build the bottom.
Yeah. And so far so good, right? I mean, if I was reading today, maybe, correct me if I'm wrong, but I think, maybe 20% of the S&P has reported. 70% or so of the companies have beaten expectations by 4% on average. Is that correct, more or less?
More or less, yeah. I mean, LPL, what I saw was only through Friday, so I haven't seen today. And this week is the big week for tech.
No, this week is huge. Yeah,
and these two, this week and next, are the two biggest weeks. So we'll get a lot more information by the end of the week. But I think, certainly the first blush, very good beat ratio. And importantly, no significant markdowns to the full year estimates, right? Because it's not even so much how did people do in Q2, it's what are they saying about Q4. And again, the fact that the analyst community is not marking down the full year consensus estimate suggests that companies, again, notwithstanding what you read in the paper every day, companies feel like they can manage their cost and their P&L and their sales structure reasonably well. And so that's, to me, is how the earnings become a bridge over the troubled waters, right? The troubled waters is the inflation environment, the uncertainty of the growth environment, and the worry that inflation is just not going to peak, right? We've had 4 months in a row where inflation has surprised to the upside, and that has really damaged a lot of people's credibility, a lot of people's confidence. I mean, we were in team transitory, and it's been a really painful place to be. But the point of the bridge, the earnings bridge, is that I think we are getting much, much closer to that inflation peak, right? We've had, in the last couple months, we've had rates roll over. Again, over the last couple of days, the 10-year Treasury's at 2.8. It was at 3.5, 70 basis points higher, 4 weeks ago. And so we had gasoline prices peaked in the US in mid-June. Rates peaked at the same time. Stocks bottomed at the same time. And now we've had further commodity rollovers. We've had gasoline prices down 37 days in a row in the US. We've had China reopening. We've had supply chain concerns easing. If you looked at the Philly Fed data last week, a lot of people focused on some of the negative outlook for growth, but there was very positive news on the supplier side in terms of supplier time, inventory backlogs, delays, pricing, etc. All those things were constructive for a supply chain that was unsnarling. And therefore, I think there's a lot of weight moving in the direction of an imminent peak in inflation. And once we get that peak in inflation, history suggests stocks do quite well. And that's why that's the idea of the bridge, the earnings bridge is between where we sit right now and that imminent peak in inflation. Earnings are keeping stocks okay. We get that inflation peak, and then stocks, again, history suggests, and it's quite strong, stocks move higher once the peak in inflation is in. It's not that you have to get down to the 2% level. It's that inflation peaks, and then the market, takes it forward, and stocks go materially higher. And so that's the whole idea behind the earnings bridge. Earnings are bridging us till we get to the inflation peak, which will, once we get it, we will set off, I believe, potentially sharply higher equity prices.
Yeah, and I want to remember something you said, maybe it was last time or the one before, that when inflation in the U.S., going back, I don't know how many years, goes from 6 to 8%, that's when you see the most significant move in the S&P. Are those the numbers more or less?
The right numbers, but in reverse. When inflation goes from 8 to 6.
Yeah, of course, 8 to 6. Yeah.
Yeah. When inflation goes from 8 to 6, again, there's not that many examples of it, but when inflation goes from 8 to 6, stocks really move aggressively in the next couple of months. And my friend and former colleague at Morgan Stanley, and a guy who incidentally knows Brazil very well, also a guy named Jordi Visser, now the president of George Weiss, a money manager, big money manager here in New York. He puts out these videos, and he put one out last week and showed exactly what happened in the 1980s, the 1990s, even the 1970s, about how the bottom in stocks, or the big move in stocks, happens once it's clear that inflation has peaked. Every time in the 70s, 80s, and 90s, when inflation peaked, stocks started to move sharply higher. And so that's the thing that I think we need to start to focus on a little bit as investors, is thinking about if that peak is indeed imminent, as I think it is. Maybe we get it with July's reading, maybe we get it with August, but I have to think with all the data points as we've laid out, showing big declines in commodities and gasoline prices, housing rolling over, et cetera, that inflation is due to peak. And once it peaks, the history of the 70s, 80s, and 90s, the work that we showed, that was actually, that chart you referenced, actually, Roberto, was in our monthly that we produced about 3 weeks ago now, that stocks tend to do very well. And so as investors, we need to be thinking about, okay, do we want to maybe start to position a little bit in front of that? And again, that's where the earnings bridge comes in. If earnings are going to be okay, there may not be another really big downdraft opportunity to add to equities, right? If earnings are fine here, and in the next month or so, we're going to get an inflation print that pretty clearly surprises to the downside, right? After 4 straight surprises to the upside, I think stocks will rip. We'll get some of those technical data points that the technicians want to see in terms of breadth thrusts and advanced decline days and some of those things. And then they'll put their weight behind a durable bottom call. And then all of a sudden, you've got all those people in that fund manager survey from B of A who were as bearish as they possibly could be. They're going to only have to do one thing. They're going to have to buy stocks. So I think that's I mean, that, obviously that may be construed as an optimistic outlook, and fine, but I think history is pretty clear. Inflation peaks, stocks jump, earnings are the bridge in a high nominal growth environment. Earnings are the bridge to that inflation peak point. And that's what we have right in front of us here for the next couple of weeks, in my view.
Yeah, no, absolutely. And and I was going to say something about inflation. I mean, of course, nobody knows, but the oil price, as you said, always, is what we should be looking out for. So looking at energy prices, and if for one thing, oil prices may not be back at 80 or 70, whatever, because there could have been an agreement or more oil from the Saudis, but at least they're not going up. And so I'm trying to think here, what could go wrong? I mean, what could make the inflation environment get worse from here? And other than that, reference to something you said in your report about the technicals, being very favorable at the moment. So, what are your thoughts on both of these questions?
Yeah, I mean, I think on what could really make inflation skyrocket, I mean, one of the things would be the full cutoff of gas, Russian gas to Europe, right? I mean, that was the big fear a couple weeks ago, and that's what drove the euro practically to parity, and actually parity, and knocked European stocks back a fair bit. But that's proven to not really be the case. Or the gas restarted, so. That still hangs out there maybe, but again, people have kind of discounted it pretty fully. I struggle to really see what else. I mean, there's the feared wage price spiral, right? If inflation expectations get unanchored and then wage gains get matched to high inflation levels, and it kind of gets embedded in the system. But that too seems highly unlikely. Inflation break-evens have come in almost harder or faster than rates themselves, right? I mean, if you look at the 2-year, the 5-year break-even inflation numbers in the US today, they've come all the way back to levels that would suggest the market is confident that the Fed is going to be able to bring inflation down. And that's, again, one of the myths out there is this idea that the Fed has lost control and the market has lost faith in the Fed. It's the exact opposite. The market is saying quite comfortably through inflation break-evens as well as pricing and rate cuts in late 2023, a year from now, rate cuts are being priced in. That tells you that it's going to be a market cycle that's very fast. Again, remember last month's title of our monthly was market speed. And so that we have a market speed rate cycle that is being priced in right now as we speak. And so the fear of a wage price spiral, that doesn't seem to be at all likely. If you look at average hourly earnings, they've come in fairly considerably over the last couple of months. And so again, that's a data point that we at TPW Advisory look at closely. The Fed looks at, lots of folks look at average hourly earnings to get a sense of that wage price risk, and it doesn't show. So we have well cashed up consumers. We have a very vibrant banking sector. I don't really see, and that's why I argue against the '08, kind of analogy. I just don't see us being in the same place in terms of the macro backdrop, and so. That's the outlook there as far as what could make inflation really much worse. And then on the other side, the technical side, in this environment that's so ahistorical and where, to be honest, a lot of historical patterns have not worked this year. A lot of the peoples who do studies who say in this environment, blah, 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 this tends to happen. This has been ahistorical kind of all the way through. A lot of historical studies have not worked. But so the technicians therefore become more important, right? When you have technical levels, there's things people can understand. The machines that trade, right, that are algorithmically programmed, they understand levels. And when everything else is kind of off kilter, the technical stuff becomes more important. And I think that's the type of market we're in. And the technicians are getting warmer because the price action is getting better, but they're still looking for, that the last Tuesday was a good example of a big breadth thrust day, panic buying, replacing panic selling. I think it was 23-1 advanced decline type of day, right? We need more of those. And that's why, to me, Roberto, what I think will bring that next one or two of those breadth thrusts that then will have the major technicians on Wall Street saying, hey, we have probably bottomed here and are going higher. What's going to bring about that environment for those breadth thrusts is going to be the peak in inflation.
Yeah, and exactly as you said, in the last session and also the session before. I mean, I remember asking you if we're seeing a bottom, and you said it's a process, right? So it's not like one day, we wake, someone just decides that okay, this is the bottom, but it is a series of events, and leaders who believe that we are in a bottom. But making another comparison. Of course, for the U.S., it's not like it's 2008, but given the things that happened the week before, it looked like this last week was supposed to be the week that Europe was going to implode, right? Because you had the ECB behind the curve. There was the dramatic Draghi resignation in Italy, and people were referring in Europe's case, not to 2008 but to 2011 and 12. And of course, it didn't happen, and much of that was already in the price, correct?
Yeah, no, and we referenced it in the musings, but there was so much to cover on the S&P side that we only gave it a reference. But yeah, I thought it was, again, very interesting. You laid it out perfectly. You had the Draghi resignation. You had the ECB go big, right? 50 basis points as opposed to 25. That was not in the price. And you had that overhang fear of Russia not turning the gas back on. All of those things coalesced last week in Europe. And what happened? Stocks were up. That has to tell you something as an investor. One of our favorite sayings here at TPW Advisory is what we like to let the market tell us what's going on, right? We don't want to presume that our intelligence is superior to that of all the other brilliant people working in the markets. So we want to let Mr. Market tell us rather than we tell the market. And last week, Mr. Market told us in Europe that an awful lot of bad news is in the price. And the fact that stocks did well with the ECB and break evens in Europe are showing the same as they are in the US. They're now, I think, the 2 or 3 year forward inflation break even in Europe is back to 2%. It was as high as about close to 2.5, 2.7, 2.8 a couple of months ago. So there too, the ECB, by coming out strong, is giving people confidence that they're going to be able to bring inflation under control. And the reality is, as we know, that the bulk of the European inflation problem is more energy driven, not quite more so than in the United States. And then the last thing I would say is your point about Italy, and we were talking about it offline, and obviously you're more knowledgeable about it than me. But the fact that Draghi has resigned, and there was a little bit of the widening on the spread between Italian bonds and German bonds, but nothing crazy, and that the overall European environment seems pretty robust, suggests to me at least that I think elections are going to be in September, early in the fall, I think, right? September something.
Yeah, September 25th.
Yeah, that people are relatively okay with what they expect to see happen. I mean, again, we talked about it. You have a pretty good sense of what you think is going to happen. Why don't you take the floor for?
We're discussing. I think. Of course, people took Draghi, the Draghi resignation very badly, especially because he was brought down by some bickering in the coalition, and of course people talk about far right parties in Italy and that kind of thing. Of course, you can talk about their stance on immigration, but what really can unnerve markets is their stance on the euro. And I think there could be the case we could have a positive surprise in the Italian elections, because there was only one of the center-right party, which is actually a far-right party called Brothers of Italy. They were not part of the coalition, but they are the largest party in the center-right coalition. And I think they may one thing is the pro establishment, the European parties, they may do something to Giorgia Meloni, like what was done to Marine Le Pen in the first French elections, when they try to put her on the spot with regards to the euro. She said a few not so smart things, and then it was too late for her to try to remedy the situation. So they make, because even Salvini, who is now very much entrenched in the establishment, he has said some things against the euro and defending Italy's exit from the euro in the past.
Right.
And there's something which is very positive about the political system in Italy. The president, Sergio Mattarella, he has a lot of respect, and the way the system works is the cabinet has to represent the ideas that were defended during the campaign. And the last election, when they had the far right Lega and the far left Five Stars, which was basically a Frankenstein, he had appointed, Lega had appointed a finance minister who in the past had written a paper defending Italy's exit from the euro. And Mattarella said basically, no, I mean, you did not campaign defending Italy's exit from the euro. So, I mean, I will not accept that this guy is the minister. So, right. And there's a lot of, and to quote, songs, there is a famous song, there's a famous quote, by Varoufakis, was a Greek finance minister during the euro crisis. Yep. And he said that, the euro is like Hotel California. So you can check out any time, but you can never leave. So, I mean, euro is irreversible. And what the smart political foxes in the Italian establishment, they may try to put some of these populists on the spot when they talk about euro. And of course, that's an exit is not going to happen. And second is, what they may try to do with these guys is try to label them as friends of Putin, because there's actually a big concern in the EU and also globally that if Lega and Brothers of Italy come to power, they may be very soft on Russia, and not even to mention Berlusconi, which is of course a very pro-business party, but now it's very small. But Berlusconi was a personal friend of Putin. Putin used to make yearly visits to his villa in Sardinia, but of course he criticized the war and everything. So there is a shot that we can get a positive surprise and in a very pro-European centrist coalition winning in Italy. But let's say the thing which is really concerning is on the gas front, because it looks like although Russia has not cut definitively, they will be supplying the minimum to have some leverage. So I don't know. My guess is as good as anybody else's on what's going to happen here.
Yeah, but I think, I mean, first of all, thank you for that kind of exposition on what's likely to come in Italy, because I do think markets are trained, right, over the last decade to think bad Italian politics equal, major problems for Europe and for the euro. So hopefully you're correct in your read that it may, in fact, present a positive surprise, which would be great. And again, kind of along the news, the idea that the news doesn't have to get better, just less bad, right? And so in Italy, that goes through a little bit of political upheaval, but is not at risk to, exiting the euro in any meaningful, likelihood, is an example of that kind of news getting slightly better type of mentality. On the energy front, to me, I think all of this has to be priced in, right? The markets last week had to price in the very real likelihood. And many people were priced and viewed that Russia would not restart the gas flowing again. And so to me, I think the market has priced all that in. And the back and forth, whether it goes from 40% to 20% because a turbine's been delayed because of paperwork, and then the turbine gets delivered, and then it goes to 30%, and then something else happens and it goes to 20%. I mean, I think this is going to be the game of cat and mouse. And, my read, my glass half full read, which is where I tend to find myself most of the time, is that, all this will keep pressure on Europe to continue to find ways to reduce their exposure to European energy or to Russian energy, right? Putin is just displaying with every one of these machinations that he is not and Russia is not a good trading partner, particularly one for something as life critical as your energy supply. So to me, it just reinforces the need for Europe to continue to move aggressively. I know there was some, back and forth in terms of the idea of voluntary rationing, but I would think that different countries will move in that direction, and some small steps in that regard can yield some meaningful results. And in the interim, we have an energy market that's pretty seems reasonably well balanced with Brent at 104. Right, not at 135, 140. It was interesting. Brent didn't move at all with the European natural gas prices, right, in terms of worries about Russia cutting off energy supplies. Brent didn't move at all. European gas has shot up again, yes, but it's still well below where it went to initially in March. And we're getting through the peak driving season in the U.S. Gas prices typically peak in the U.S. at the end of July. We're in the last week of July right now. Gas is already down, as we talked about earlier, 37 days in a row. It's probably going to come down another 10% if you look at the spread between wholesale and retail pricing currently. So I feel reasonably good about the energy backdrop, and even reasonably good about still holding energy securities. They had a pretty good day today, actually. Natural resources had quite a strong day today after having been hit quite hard on the recession fears. So I think the market, let's watch that space. Maybe the market is starting to think that starting to price in slow growth, as we talked about, not no growth. Right? We talked back in the spring, our conversation was all about slowing growth. Is not no growth, and so here we are again. But I feel like the energy space is stabilized, and hopefully there'll be more stabilization on the European side, particularly on the gas front.
Yeah, no, I totally agree. I mean, I think the direction is clear. Europe, everybody understood that they have to get rid of their Russian dependency, so they're looking for alternatives. Be it in Algeria, Qatar, building the LNG terminals in the ports in Germany. Of course, you cannot do this in a year. So this year is going to be a big test, and a lot of people saying that Germany will have, on Europe, we have to ration gas, but at least we're still 3 months away. I like to say that there's no such thing as an announced tragedy. So, when everybody thinks a tragedy is going to happen, of course, people do something about it. So, but I totally agree with you. The direction is totally clear. So, how about China, Jay? Are things starting? Because I think, if I'm not wrong, Citi and maybe one of the other major banks said that things are really turning in China. Despite some noise, in the news, from time to time. Do you think that's the case?
Yeah, well, we've talked about for some time again how the first segments of the market that went into the bear market in Q1 2021 would be the ones to lead us out, and we've been highlighting China and the innovation space as two of those leaders that are now bottoming and leading us out. And China bottomed back in the spring. KWeb, which is what we use to express a view on China tech, bottomed back in April and is up 25 or 30% since then. It's pulled back a little over the last couple of weeks, which I think is just healthy because it made a 40% move in the space of a month or so. ARK, by the way, has had a similar 40% move. So ARK, as a representative of the innovation space, bottomed back in early June, did not make new lows when the S&P and the NASDAQ did, and is up literally 40% and broke through an important technical level around $45 last week. So China, to me, it looks as if they're starting to be a little bit more aggressive on the policy front. You know, we just saw a talk of a program to support the property developers, which, you know, there's been some scenes of some domestic violence and unrest around the property space. And property is, you know, critical. It's where most Chinese have their savings.
That's right.
It's absolutely critical to social stability. So while some would look at those video clips of, you know, people massing in front of banks asking for their money back and say, wow, China's a disaster, I would look at that and say, wow, the government is going to have to respond because everyone's savings in China are in some way tied to property. So to me, the fact that, and lo and behold, here we are, you know, today with the government coming out with a plan to support property developers to finish these unfinished apartments that people have already paid for.
Yeah.
And so I think that's a good sign. Property is an important segment of the economy. It's an important segment of the market. It's an important source of demand for raw materials like iron ore and copper. So I think that's probably one reason why natural resources bounced today, was because of that report. Makes perfect sense.
I don't know, had a big bounce. Yeah, Brazil did well today because of that.
Yeah, 4% move. I saw that. So to me, you know, China has the policy space, both monetary and fiscal. They have the upcoming People's Party Congress, where President Xi is going to look for a third term. I believe the fact that China is accelerating out of the COVID lockdowns while the US and Europe are decelerating is an important distinction that we need to make and understand that that's bullish for the global economy, because China is a huge component of global growth. And while they're not going to, most likely, it's impossible to make their 5% full year growth target, given how weak the first half of the year was in lockdown. It's quite likely that China could grow 5% in the second half of the year. And that could be very much one of the things that keeps the global economy away from any kind of hard landing or recession, is that we have China, you know, a 15 to $20 trillion economy, the size of the US, the size of Europe, growing at a 5% rate in the second half of the year. That's going to be very, very good for the global economy.
Yeah, no, I totally agree. So as we said last time, you know, the oil, you know, the big tanker is moving. So I mean, we have like 10 minutes left. One of the things I wanted to talk about is climate. I mean, there's no way we cannot talk about it, you know, given that, you know, the world is you know, sweltering. You know, there's a huge heat wave in Europe. This is a really shocking one. I mean, I can't remember. You know, maybe in 2003. It was as shocking as this one. We got people concerned and politicians to talk about, you know, rakes, records being smashed everywhere, also in the U.S. So how does that change your outlook on climate? I mean, of course, you know, we've been very positive and we think this is critical. But do you think, you know, a couple of weeks like the ones we've had, will that get politicians to act?
Well, I mean, we saw probably the final act in the Build Back Better saga in the United States over the last week or two, with Senator Manchin finally basically putting the stake in the heart of the Build Back Better program, which is where the bulk of the climate spending for the United States was going to be generated. So, the U.S., again, unable to move politically in the right direction, in forcing the president to do things by executive action, is not a great outcome for the United States. It does continue to leave Europe, I believe, in the driver's seat globally as the climate leader, much as Europe is kind of the regulatory leader for the technology space. It's rapidly going to be the climate leader because it's being pushed so fast by what's happening with Russia. And as long as Europe, notwithstanding the short-term need to maybe use more coal or things of that nature to get through this next 12 to 18-month period, to me, that's not a huge problem, right? It's what has to be done to keep the lights on. That's understandable. But as long as Europe moves forward and continues moving aggressively on Fit for 55 and its other efforts to accelerate green and clean energy in Europe, then Europe is going to be the dominant player there in that space, and that's bullish for the European companies that participate there. And so, we continue to be, it's the biggest segment in our TPW 20, our thematic model portfolio. Climate represents about 37%, give or take a few. The next closest is next gen tech, which is about 24%. So it's the biggest by far. And recall, we split that up into kind of transportation and power generation, because that's where the bulk of the emissions come from. Either transportation, driving your gas guzzling car, or power generation, burning coal to keep the lights on. And the EV revolution is clearly happening. It's happening, right as we speak, and we participate in that through ETFs like LIT, which is the lithium and the battery ETF, and that has done quite reasonably well. It's up 20% off its lows, as an example. The battery makers are setting up shop in every major region. Our tripolar world thesis of regional integration manifesting itself through the climate prism, as every country wants to have a battery production plant in its region. Same with semiconductors, right? Every country or every region wants to have a semi-fab plant in its region. So we see this, we see things like climate and COVID and conflict is really driving the adoption of the regional integration framework that we've been talking about for over a decade. We see it manifesting, and we see companies driving that manifestation. So we call Tesla a tripolar world company because it has production, world-class, state-of-the-art production in China, in Germany, in the United States. And we see more companies moving in that direction. So the EV is kind of the sharp tip of the spear from what we can tell in terms of, climate adoption by investors. And then on the power side, there are a number of different ETFs. We like the International Clean Energy, ICLN, which we've talked about for some time. We recently put that back into both portfolios. It's been in the thematic portfolio for about 3 months now. We added it to the global multi-asset model last month. We also have things like uranium. You may have seen that Japan is going to restart about a dozen nuclear power plants to protect its energy supply demand profile. So URNM on the uranium side, we do think nuclear power has a role to play as a baseline provider as we move increasingly to more renewable power sources. And then we have things like KRBN, carbon, which is the emissions trading system that prices carbon. And I think that's another ETF that we like, that actually has been performing a little less well because people worry that with the spike in energy prices in Europe, politically there may be pressure to play around with the ETS to limit its ability to put further pressure on upward prices. And so that ETF actually is probably worth a good look at current prices, down around 43 bucks, give or take. So yeah, we continue to be constructive on climate. We think it's the only issue in the world where every government is going to spend money in the next 10 years between now and 2030. We think it's the biggest global macro trend of all. And that's why it has the 37% weight in our, TPW 20 100% thematic model portfolio.
Yeah, no, it's excellent. And finally, some words on the dollar because it seems critical to your market view. So has the dollar peaked?
No, that's great, Roberto. And one of the reasons why I love doing these with you is that you always keep good track of the questions. Because
It's my job.
when I'm talking and getting into the flow of it, I tend to forget a few pieces. And the dollar was one that we talked about at the offline to say that we really wanted to spend a few minutes on it. So thank you for, as usual, making sure that we don't miss that. I think the dollar is key here. If the dollar were to peak and roll over, it would be, I think, a very good signal for stocks. It would be a very good signal for international stocks. It'd be a very good signal for EM. It would be a very good signal for commodities. The dollar has been what some people have said, and somewhat correctly, maybe a little bit overstated so far, but some people have called it the wrecking ball. Right? It's at I think it's at a 10 or 20-year high, depending on how you want to measure it. It's been very strong against the majors. The euro, the yen, both have been quite weak. The EM currencies, Brazil, as we've talked about, was at 545, went under 5 and is now back to 545. I guess maybe today 535. But Brazil's a good example. Many of the EM countries have seen record lows of their currencies versus the dollar. Even though arguably they're in better shape than they have been in the past to deal with a stronger dollar. It's that muscle memory of investors who recall, when the dollar's rising, you don't want to be in EM. So I think we're at an important point here. Typically, and again, this is an example how this cycle, the COVID cycle, has been ahistorical. Historically, the dollar falls when the Fed tightens, right? Because it's anticipating it's anticipating the end of the tightening cycle. And in this cycle, of course, being ahistorical, the dollar has continued to rally while the Fed has tightened and messing up people. Certainly us at TPW, we did not hedge any of our international exposure. And, we could have done much better if we had hedged our Japanese equity position. Now I think it's too late. But for those who did, kudos. It's way outperformed the unhedged. But for now, I think at 106, 107, we are going to have the Fed meet this week. It's most likely going to be a 75 basis point increase. Probably not going to say a whole lot about the future. We then have August off. Let's remember, we don't have a Fed meeting in August. We have Jackson Hole, right, where everybody gets together for the big kind of corn fab. And then we have the Fed meeting in September. So, I think between now and September, a lot can happen. I think that we could see the peak in inflation, as we talked about earlier, maybe a sharp surprise downward to offset the 4 months of upward surprises on inflation. And I think that could change some calculations of what people expect down the road. But irregardless, I think the market seems pretty well settled on a Fed funds rate of 3 to 3.5 by year end. And I think people are pretty comfortable around there. But the dollar is really the key, right? How the dollar reacts here, I think, is going to be really pretty important. And my thought is that the definitive peak in inflation then kind of starts to rule out a ever aggressive Fed because the pressure on the Fed starts to ease. That sends a signal to the dollar that, hey, maybe we don't have a lot of upside here. We're kind of exposed people have priced in the worst in Europe. People thought that Japan was going to have to break their yield curve control approach to protect the 25 basis point level in the JGB. Didn't happen. Maybe so maybe there's some room to kind of go back and put a bid under some of these big majors and take some pressure off the dollar. And if we see that, people are long the dollar. It's been a working trade. People have been following trends and momentum in this market. That's been one of the best ones, long dollar. When it peaks and rolls, I would expect it rolls over pretty fast and pretty aggressively, and that gives lift to the things like equities and commodities, and particularly non-US and EM equity.
That's great. So looks like things we're shaping up for a good second half. Everything looks like so. We covered a lot of ground this time. It was excellent. Thanks very much. And go back to your well-deserved vacations, and we'll speak in 2 weeks.
Yes, I have a cocktail waiting for me down by the pool, Roberto. So I'm going to do exactly that. But great being with you and with the OM audience as always. Everyone have a great couple of weeks, and we'll see you back in 2 weeks. Thank you.
See you in 2 weeks. Likewise. Enjoy. Bye-bye.